Good morning. This is called a put chart on the S&P 500. Yes, it is a weekly chart on the 2000 strike price September 14th. During the holiday month of August, why do I say it that way? Because everybody takes vacations. Look, on 8/3, this 2000 put was in the money. The high was $97.38. This put option on the S&P index has been walked all the way down here to $16.50. Now, on the flip side, I'm going to show you this. We are going to buy these put options for September. Yes, we make a lot of money when the S&P 500 is overbought. This is a 2014, September 2014, 2000 put, and we're going to buy them. And because we waited the month of August out, we are going to have the very lowest prices. And here is the following. This is the 2000 put on September 14th expiration. On a daily level, you can see from $97 here, you can see that this is a daily movement, and you can see that this is totally deflated. 1660 is the low. We are going to have the lowest dollar risk entry than anyone else on the street. A lot of people got killed in August by buying these put options. The dog days of August on low volume tape, you don't want to be short. And then again, when you're long, you also have to be careful. Now, on the flip side of this, I'm going to show here of where this particular 2000 call, September, was a monthly low of $3.20. Then we started to break out from $3.84, and we shot straight up here on 8/26, and this particular 2000 call was up and out of the money, and they ripped it. What a big trade. They ripped it to $21, okay, versus the put side. And one of the things that we're going to show everybody is that we will also take the 1970 put call. This is a 1970 strike. The low on that was $8.50. They ran that to a high of $41.78. If you would have had 10 contracts for the upside, we had a big pullback, and when we did, we had made a low on the call. When the index and the S&P hit that low on daily, weekly, and monthly. And we're going to be buying this, and we're going to make a lot of money. I just want you to know that the 1970 call is one of interest. The really big one for right now also is this call. 1950 is the strike. The low on 8/7 was $14.66. Big move on the call side in the S&P to $59. You had 10 contracts, 5 contracts, you're walking away big time fat city. I am going to say that we're going to get into an overbought level when we look at the call side of the S&P. I'm also going to take the 1975 put option. And why can I buy this down here? This was the high on 8/7 at $78 a contract, and we're buying, and $9.40 is the low. This side of the market is totally deflated in value. Once again, that's the 1975 put that's in the money, and we can buy that. And our risk is low because the contracts is the way to use these index put contracts, both call and put side. It really doesn't matter. I am also going to show the 1990 put. On September 14th, this is what it is, and this is what a put chart looks like. So, starting on 8/6, they were $88. And right now, on 8/29, they hit $13.81. So when we are going to trade the S&P 500 short, all this risk is out of the way for the MMTs to have the very lowest strike price in the S&P 500 contract. I have before us right now, MMT, the S&P 500 index, September 14th of year 2014 expiration here at the 1990 put. They were up here again, now, 88.70, and now we're at a low over here, 1381. That means that when September 2nd comes around, happy Labor Day to everyone, as we're going to be taking nice big positions in this S&P. Why? Because they have walked these things down to a deflated area. Once again, we are masters of buying imbalances between the call and the put side of that S&P. And right now, we're getting ready to load up at certain price levels on Tuesday on the 1990 put. This is all done before the fact. How to trade the S&P 500 index options on a monthly calendar of 2014. I've gone through quite a bit of them. I will also let you know that the 1985 put was just up here on 8.1. It started out at 82.50. And the institutional people who buy these things at $47, and this is a calendar 1985 put on the S&P 500. Why are we going to be the very lowest people on the street to trade this 1985 put? And why is it that it's been totally deflated? And why is it that we are masters at indexes and we are masters at getting the lowest price with what? Mathematically imbalanced call to put ratio on that S&P 500. Now, I'm also going to show you right back here, this was the call side and it was out of the money. And it went from $5 and it hit a high up here. So the call side worked out real well on 826. Just recently, we topped out at 30.20. And this is what happens. They marked them down on the call side when we had that big reversal. You can see that on what? The September 14th contract. Yes, there are weeklies you can trade in there, but right now we're focusing on the monthly one. And I'm just showing that this is inflated, and it can get inflated again. This particular one, 1985 and 1985 both call and put in this video. And why is it that the SMF market maker is going to get the all-time lows when we take a look at why we sell these? But why are we going to be the all-time low right here? This is the put side, and I showed you the call side. Both are the same strikes for September. Once again, taking out all the risk, we will be making our entries at a lower price level starting on 9/2 of what? 2014. Call and put ratio on the S&P 500 index.